Hi friends, welcome back to the channel. In today's video, I will talk about my investing philosophy. First, let's talk about saving. So in order to have any form of saving, first I need to have an active income, and after the spending, there will be some money left over. So I will take the money and invest. Why saving is very important? Because in the initial years, the growth of your portfolio is mainly determined by how much money that you put into the portfolio and not the investment returns. Imagine that you put 1,000 a month into your portfolio, regardless of whether market goes up or down, and you can see that your portfolio will still grow over time. But once your portfolio grows to a certain size, you can see that the investment return will play a much greater role. And the basic idea is to build a sizable portfolio. Why do we need a sizable portfolio? Imagine that your portfolio is very small, like 5,000, 10,000. You can double your monies, but the amount that you earn is actually still very small. So in contrast, if you have a sizable portfolio, say 500,000 or 1 million, just a 5% returns is a very decent amount. So if you are only starting investing, please don't focus too much on the market direction and market volatility. Focus on the amount that you put into your portfolio every month. Because the growth of your portfolio is mainly determined by how much you put into it. My next investment philosophy is mainly investing in equities. If we are comparing equities with bonds, equities is just so much better. Just look at a single company. If the fundamentals of the companies is doing well, the share price will just keep going up and up. There is basically no limit of how much the share price can increase. For bond investment, the yield that the investor can get is actually limited. What about the scenarios where the companies is failing? The values of the equities will likely go to zero because the bondholders has the rights first to the company assets in the scenario where the company is liquidated or bankrupt. But if you invest in bonds, is it really safe? Many people thought that investing in bonds is very safe, but just look at Evergrande bonds. When the company is facing risk of bankruptcy, the bond value also drops together. This is because if the business is dying, the bondholders can also lose 100% of their capital. That's why, in my opinion, it is a very bad proposition to invest in bonds. Question is why people still invest in bonds, right? I think people are attracted to investing in bonds because it gives illusions of stability. During a normal times, a healthy company's bond price will be very stable, so the investor can get like a couple % of returns and they are happy with it. In contrast, if you are investing in equities, you can see that the share price still going up and down even though the company is doing well. However, investing in bond is very costly because the upside is basically capped. Back to equities. How much return can we expect from investing in equities? If you are only investing in S&P 500, you can reasonably expect a 10% returns over the long term. This is quite an attractive investment because you basically don't have to spend so much time researching stocks and just buy into ETF, and you can get a very decent return. And for those who are interested in investing in individual stocks, as long as you pick companies that have strong fundamentals, it's likely that you can outperform S&P 500 by a couple of percentage. Next, let's talk about market timing. If you observe most of the investment guru, what kind of investing advice they are giving? I see many of them giving market timing advice. For example, those that say Nasdaq have turned bearish with 3-0 and we should take profits. I'm not saying that market timing is all useless because there are people who can do this successfully. It is just not a game that I know how to play. My belief is well summarized by one of the quote from Charlie Munger, which is that the big money is not made in buying and selling, but in the waiting. So instead of trading in and out from the markets, my approach is just constantly buying and using a dollar cost averaging approach. I think this is the best approach to take advantage of the compounding. So how does compounding work? It's actually quite simple. Imagine that we start from a portfolio of 10,000 and I earn 10%. So from 10,000 it becomes 11,000. Then the next period, the money that we earn is on the base of 11,000. In other words, the earnings that we get will actually help us to earn even more in the future. And over time, beside the market return, we still continue to put in money every month, making our portfolio even larger and then earning even more monies. So you may ask, what if the market drops instead of going up, right? My strategy is still the same, which is consistently putting money in. So even if the market drops, because I'm still putting money in, the portfolio size shouldn't drop that much. And I think that it is a good idea to buy when the market price is cheaper because the prices are more attractive now. I will avoid market timing, especially those market timing that focus on the general market, because it is very hard to successfully time the market. Do you know who can consistently predict the market crash? For example, the crash during COVID crisis, the global financial crisis and dot-com crisis. There's only one group of investor or market commentators that can consistently predict the market crashes. These are the group that I call perma-bear, because regardless of when you ask them on the market outlook, they will tell you market is going to crash. So my advice to you is please don't listen to this guy, because to them only cash is a good investment. So that's all about today's video. I hope you enjoy and see you in the next one. Cheers, bye bye.